Have you ever wondered how some people manage to achieve financial success while others struggle to make ends meet? The answer lies in having a solid understanding of personal finance. What if you could confidently make financial decisions that align with your life goals? Imagine having the knowledge and skills to navigate the complex landscape of personal finance with ease. Embarking on a successful financial journey requires essential knowledge. Master budgeting to control spending. Establish an emergency fund for unforeseen bumps. Wrangle debt smartly, while grasping interest rates. Understand investing basics, considering your risk tolerance. Plan for retirement strategically. Differentiate between short-term quick wins and long-term gains. Harness the power of compound interest. My name is Darius. Welcome to Personal Finance Insights, the channel that helps you make sense of your money. This video covers it all. Whether you are aiming to eliminate debt, save for a dream vacation, or retire comfortably, this video will empower you to make informed choices. And say goodbye to financial uncertainty and hello to a world of financial mastery. Your journey to financial success starts here. Let us embark on this journey toward financial success together. I will start by establishing your financial foundation through budgeting. Before you jump into the world of investing, it is important to set up a strong budget. Think of a budget like a map for your money. It shows you where your earnings are being used and where you might be able to spend less. To start off, make a list of where your money comes from, like your job, and the things you spend money on regularly, such as rent, groceries, and utility bills. Then, decide how much of your money you want to save and invest. Sticking to your budget is a smart way to make sure you do not spend too much and to create a safety cushion for yourself. A budget is like a tool that helps you manage your money wisely. Just like you plan a route before taking a trip, a budget lets you plan where your money will go. It is all about knowing how much money you have coming in and making sure you are using it for the things that matter the most to you. First things first, jot down how much money you get regularly. This could be from your job, or any other way you make money. Once you have that figured out, make a list of the things you spend money on each month. These are usually things you cannot avoid, like paying for a place to live, buying food, and taking care of utility bills like electricity and water. Having a clear picture of your income and expenses helps you see where your money is being spent. Now comes the exciting part, deciding what to do with the money that is left after you have covered your expenses. This is the money you can save up or invest. Saving is like giving a little present to your future self. It is money you set aside for things you might want later, like buying a new bike or going on a special trip. Investing, on the other hand, is like planting seeds that can grow into big trees. Your invested money has the potential to increase over time, helping you have more money in the future. To make all this happen, it is super important to stick to your budget. It is a bit like following a recipe. If you do not stick to the instructions, the result might not turn out as expected. Similarly, if you do not stick to your budget, you might run out of money before the month is over. So, keep track of your spending, and try your best to spend only what you have planned in your budget. Sticking to your budget offers a bunch of benefits. First off, it helps you avoid spending too much money on things that are not important. It is easy to buy small things here and there, like a snack or a drink, but those expenses can add up without you even noticing. A budget keeps you mindful of where your money is going so that you can use it for things that truly matter, like your goals and dreams. Additionally, having a budget gives you a sense of control over your money. Instead of wondering where all your money went by the end of the month, you will know exactly where it went. This control empowers you to make smarter decisions about how to use your money, ensuring that you are working towards a stable financial future. In a nutshell, before you start thinking about investing your money, start by setting up a budget. It is a simple but powerful tool that lets you manage your money, save up for the things you want, and build a solid foundation for your financial journey. Just remember, a budget is like a friend that guides you through your financial choices, helping you make the most of what you have. Once you have established a solid budget, the next prudent move is building an emergency fund. Life has its surprises, and some of them come with a hefty price tag. That is where an emergency fund comes in. Think of it as a safety blanket for your finances. This fund is like a savings stash that is there to catch you when unexpected things pop up, like sudden medical bills or surprise car fixes. The goal? To tuck away enough money to cover 3 to 6 months' worth of your usual expenses. This way, you can breathe easy knowing you are prepared for the unexpected, and will not have to lean on credit cards or loans to stay afloat when those surprise costs show up. Imagine this: you are cruising along, everything is fine, and then bam! Your car starts making funky noises or you twist your ankle playing basketball. These things happen when you least expect them. But guess what? An emergency fund's got your back. It is your financial sidekick, there to swoop in and save the day. Think of your emergency fund as a piggy bank for grown-ups, a place where you put aside some cash for a rainy day. Except, in this case, the rainy day might be a busted pipe or a surprise vet bill because your furry friend thought eating your shoes was a gourmet meal. Now, how much should you stash in your emergency fund? Aim for 3 to 6 months worth of what it usually takes to keep the wheels turning in your life. That means rent or mortgage, groceries, utilities, and all those other bits and bobs that keep your world spinning. Calculate what that adds up to and make it your goal. Having this financial cushion is like having your own superhero cape. It lets you stay strong and in control, even when life throws its curveballs. Imagine not having to sweat it when your laptop goes kaput or when you accidentally drop your phone in the toilet. Your emergency fund steps up, so you do not have to worry about whipping out the plastic money and piling up debt. The key to a solid emergency fund is to build it up bit by bit. Set aside a portion of your paycheck regularly, just like watering a plant to help it grow. Before you know it, you will have a safety net that is there to catch you when you stumble. In a world where surprises are around every corner, having that financial safety blanket can make all the difference. You are not just saving money, you are saving yourself from stress and worry. So, start your emergency fund today, because you deserve that peace of mind. Your future self will thank you when the unexpected becomes just another part of life's adventure. Your financial safety blanket prepares you for unexpected challenges, allowing you to take the next step in securing your financial stability. Once that foundation is in place, tackling what you owe through debt management becomes a manageable goal, as your emergency fund provides the necessary buffer to address debts without derailing your progress. Now let us talk about debt management. Having debts can feel overwhelming, but with the right strategy, you can handle them well. Start by focusing on the debts that cost you the most, such as credit cards and payday loans. Craft a plan to pay them off, and think about combining all your debts into one to make paying them back easier. By steadily chipping away at what you owe, you will gradually shrink your debt load. This will give you extra money from your earnings, which you can then use for saving and investing. Dealing with debt might seem like a big task, but you can break it down into smaller steps to make it more manageable. The key is to begin by tackling the debts that have the highest interest rates. These are the ones that are costing you the most money in the long run. Usually, credit cards and payday loans fall into this category. By focusing your efforts on these high-interest debts, you will stop them from growing even larger. Once you have identified the high-priority debts, it is time to come up with a plan for repayment. This means figuring out how much you can afford to pay each month. Try to allocate more funds to the debt with the highest interest rate while making minimum payments on the others. As you pay off one debt, you can then shift that money towards the next one on your list. This snowball effect will gradually speed up the repayment process. If you have multiple debts from various sources, things can get a bit confusing with different due dates and interest rates. This is where consolidation comes into play. Debt consolidation involves combining all your debts into a single loan or credit account. This simplifies your financial life by giving you just one payment to focus on. Plus, you might even secure a lower interest rate through consolidation, which would save you money in the long haul. Staying patient and consistent is the name of the game when it comes to paying off debts. It will not happen overnight, but with determination, you will steadily see progress. Every payment you make chips away at the total amount you owe. As your debt shrinks, you will find yourself with more breathing room in your budget. This extra financial flexibility is a great opportunity to start saving for your future, and investing in things that matter to you. Remember that managing your debts is entirely doable. By tackling high-interest debts first, making a repayment strategy, and thinking about consolidation, you are taking the right steps. Be patient and persistent. Over time, your efforts will lead to a lighter debt load and improved financial freedom. This means more funds for your savings and investments, setting you on a path towards a more secure and prosperous future. To effectively manage your debt, it is essential to grasp the concept of interest rates, as they play a crucial role in both the cost of borrowing and earning. Now let us talk about interest rates. Interest rates play a vital role when it comes to borrowing and investing. Imagine you are borrowing money from someone. If the interest rate is high, it means you will end up paying back more money over time. Conversely, when you put aside some of your earnings or savings into investments, higher interest rates will make your money multiply more quickly. It is important to pay attention to these interest rates whether you are thinking about getting a loan or trying to decide where to keep your savings or invest your money. Let us break it down a bit further. Borrowing money. When you borrow money, you are asking to use someone else's money for a period of time. This could be for various reasons like buying a car, a house, or paying for education. However, the lender does not lend the money out of kindness. They charge you an extra fee for using their money, and that fee is called interest. This interest is usually a percentage of the total amount you borrowed. If the interest rate is high, you will have to pay back a larger chunk of money on top of what you originally borrowed. So, when interest rates are high, borrowing becomes more expensive. Growing your money. On the other hand, when you decide to save your money or invest it, the financial institution you save with, or the investment opportunity you choose might give you something extra as a reward for letting them hold onto your money. This extra is also interest, but now you are on the receiving end. The higher the interest rate, the faster your money will grow. It is like your money is making little baby money while it sits there. Being smart about it. Whether you are borrowing or investing, interest rates matter. If you are thinking about borrowing money, it is smart to shop around for loans with lower interest rates. That way, you will not have to pay back as much extra. On the other side, when you are considering where to put your savings or invest your hard-earned money, choosing accounts or opportunities with higher interest rates can help you grow your money more effectively. So, remember this, interest rates are the extra price you pay when you borrow and the extra prize you earn when you save or invest. Keep an eye on them because they can have a big impact on your financial decisions. Whether you are taking a loan or planning your financial future, understanding the role of interest rates can make you a savvier money manager. Once you grasp these concepts, you will be better equipped to dive into investing basics, such as making your money work for you, as it builds upon your understanding of interest rates to help you grow your wealth through strategic investments. So, let us talk about investing basics. Investing is like planting seeds of money in different fields, such as stocks, bonds, or real estate, hoping they will grow into a bigger harvest over time. This helps your money work hard to make more money for you. To keep things safe, it is smart to not put all your eggs in one basket. Instead, spread your money across different types of investments. This is called diversification, and it is like having different kinds of plants in your garden to protect against bad weather. Now, let us talk about stocks and bonds. Imagine stocks as pieces of a company that you can buy. If the company does well, the value of the pieces you own goes up, and you might be able to sell them for more money than you bought them for. But remember, companies can also have tough times, and the value of your pieces might go down. This is why stocks can be a bit like a roller coaster ride with ups and downs. On the other hand, bonds are more like loans that you give to companies or even the government. In return, they promise to give you back the money you lent them along with some extra, which is called interest. Bonds are like a steady train ride. They might not give you huge amounts of extra money, but they are generally safer and more predictable than stocks. If you are new to investing, a good way to start is by using something called low-cost index funds or exchange-traded funds, ETFs. Think of them as ready-made baskets of different types of investments. When you buy a share of an index fund or an ETF, you are buying a tiny piece of all the plants in the garden. This way, You do not need to worry too much if one plant does not do well, others will make up for it. These funds are like the training wheels of investing. They help you get the hang of things without too much risk. Plus, they usually don't cost a lot to own, which means more of your money gets to stay and grow in the garden. In a nutshell, investing is a way to make your money grow. It is like growing a money tree, but instead of water and sunlight, you use different types of investments like stocks and bonds. By spreading your investments, you are not putting all your hopes on one plant. Some might grow more, some less, but together, they help protect your garden from storms. Remember, just like plants take time to grow, investing also needs time. You might see your money go up, and sometimes down, but over the years, it has the potential to grow into something bigger. So, whether you are dreaming of a new bike or thinking about the future, investing is a tool that can help you reach your goals, all by letting your money work hard for you. Once you grasp the fundamentals, delve into knowing how much risk you're okay with when investing to tailor your strategy to your risk tolerance. Now let us talk about knowing how much risk you're okay with when investing. Knowing how much risk you are okay with is super important when you are thinking about investing your money. People have different feelings about risk. Some are cool with taking big chances if it means they might get a big reward. Others like things to be steadier and more reliable. Figuring out your risk tolerance means thinking about what you want to do with your money, how long you are planning to keep it invested, and how well you can handle the ups and downs emotionally. All these things help you decide how much risk you are comfortable with. And that decision will help you pick the best investments for you. Alright, let us break it down a bit more. Risk tolerance is like finding your sweet spot in a game. Imagine you are playing basketball. Some players love to make daring shots from far away because if they score, they get a lot of points. But if they miss, they might not get any points at all. On the other hand, some players like to get closer to the hoop, where they have a better chance of making the shot. They might not get as many points each time, but they are more likely to score overall. So, it is not about what is better or worse, but what feels right for each player. Now, think about your money as those basketball shots. When you invest, you are trying to make your money grow. But there is a chance you might not make as much as you hoped, or even lose some. It is like taking shots from far away, big gain, but also big loss. Or you can choose investments that are like shooting from closer to the hoop, smaller gain each time, but more likely to end up with points overall. To decide where you stand, ask yourself a few questions. 1. What are you aiming for? Are you dreaming of big rewards, even if it means things might go south sometimes? Or are you more interested in seeing your money grow slowly and steadily over time? 2. How long can you play? Are you planning to invest your money for a short time or a long time? If you are in it for the long haul, you might be more comfortable with some ups and downs along the way. 3. How tough are you? Emotionally, that is. Can you handle seeing your investments drop without freaking out? Or does that make you too stressed? When you have the answers, you can figure out if you are okay with a lot of risk, or if you would rather play it safe. It is all about finding your comfort zone, just like in that basketball game. And once you know where you feel good, you can start looking at different investments that match your style. If you are a daredevil, you might want to look into stocks that could go up, or way down. If you are more of a steady Eddie, you could focus on bonds or stable companies that do not swing around too much. Remember, there's no one-size-fits-all answer. It is about what suits you and your game plan. So, take some time to think, what kind of player are you going to be? Assessing how much risk you are comfortable with in your investments ensures a secure financial future for retirement, aligning your choices with your long-term goals. Now let us talk about planning for retirement to ensure a stable future. Planning for your retirement is a step you cannot start too soon. Two familiar retirement accounts, the 401k and the individual retirement account, IRA, come with valuable tax benefits. By contributing to these accounts on a consistent basis, you open the door to the power of compound interest, which can grow substantially over the years. If your employer provides a 401k match, Make sure to utilize this opportunity fully. Think of it as a gift of free money working towards your retirement. Getting ready for retirement. The importance of preparing for retirement cannot be overstated, and the sooner you begin, the better. Familiarizing yourself with retirement options like the 401k and the individual retirement account, IRA, can make a significant difference. These accounts are designed to provide you with tax advantages that can enhance your savings. By making consistent contributions to these accounts, you set the stage for compound interest to come into play. Over time, this compounding can lead to considerable growth in your retirement funds. Looking at tomorrow. The journey towards a secure retirement begins today, no matter your age. Becoming acquainted with retirement avenues such as the 401k and the individual retirement account, IRA, can prove highly advantageous. These accounts are not just about stashing away funds, they come with tax incentives that stretch your savings further. Regularly allocating funds to these accounts sets off a domino effect known as compound interest. This financial phenomenon ensures that your money earns interest on top of previously earned interest, fostering substantial growth over time. When your employer participates in a 401k matching scheme, it is like giving your retirement savings an extra boost. This is an occasion to amass additional funds without exerting extra effort. Planning for retirement to ensure a stable future is a crucial financial goal. One key strategy in achieving this is understanding the amazing power of compound interest, which can significantly boost your savings over time. Now let us talk about compound interest. Imagine a magical force that helps your money grow in a way that might astonish you. This phenomenon is called compound interest. It is like a secret ingredient that can make your money multiply gradually but remarkably. Let us uncover the mystery behind compound interest in simple words. When you put your money into a savings account or an investment, you earn something called interest. This is a bit of extra money that the bank or the investment gives you for letting them hold onto your money. Now, compound interest takes this a step further. It does not just give you interest on the money you put in, it also gives you interest on the interest you have already earned. It is like a reward for being patient and letting your money stay where it is. What is exciting is that the longer you leave your money untouched, the more this compound interest works its magic. Imagine you have a plant. At first, it grows from a small sprout into a little plant, and then it grows even more from its branches. Compound interest is similar. It grows not only from the money you originally gave but also from the interest that gets added along the way. Starting early with compound interest is like planting a small seed and watching it turn into a majestic tree. The more time it has, the taller the tree can grow. Similarly, the longer your money is invested, the more impressive the effects of compound interest become. Even if you do not add more money to your investment, the interest keeps building on itself, creating a sort of money snowball that rolls down the hill of time, getting bigger and bigger. Think of compound interest as a friend that grows your money crew. Say you invest $100, and it earns you 10% interest annually. In the first year, you will earn $10, bringing your total to $110. But in the second year, you do not just earn $10 on your initial $100. You earn $11 on $110, which means you end up with $121. See how it is adding a bit more each time? As the years go on, this addition becomes even more impressive. That is the magic of compounding. So, if you want to make the most out of this magical phenomenon, start early. The sooner you begin, the longer your money has to experience the power of compounding. Even if you cannot invest a lot at first, do not worry. Consistency is key. Adding even a small amount regularly can lead to substantial growth over time. So, let us talk about long-term versus short-term goals. When you think about your money, it is important to connect it with your dreams. You see, the way you invest your money should match what you want to achieve. Some dreams are like a quick sprint, like buying a car, while others are more like a marathon, such as planning for your retirement. Let us talk about how to make sure your investments line up with your dreams. Short-term dreams like buying a car. Imagine you're excited about buying a shiny new car. You do not want to wait for years and years to make this dream come true. So, You need to invest your money in a way that keeps it safe and stable. It is like putting your savings in a strong box where it will not bounce up and down too much. This is because you want your money to be ready when you are. When you are aiming for short-term goals, like that car, you cannot afford to take too many risks. If you invest in something super risky, like a roller coaster, you might end up with less money when you need it. That is why it is smart to choose investments that are like a calm lake, not too wavy. Long-term dreams like planning for your retirement. Now, let us fast forward a bit and think about your retirement. It might seem far away, but it is a big dream, and it takes time to build up enough money. Unlike the quick car goal, you have a lot more time to play with when it comes to retirement. This means you can take some risks. Imagine your money as a seed you are planting in the ground. Over time, you want it to grow into a giant tree of wealth. Trees need water and sunlight, and your money needs a little bit of risk to grow. If you stick your money in a super safe place, like a vault, it will not grow much, and you might struggle in your retirement years. So, for long-term dreams like retirement, it is okay to invest in things that can go up and down like a roller coaster. Why? Because you have time to ride out the ups and downs, and in the end, your money is likely to grow much bigger. Also, keep an eye on your dreams and your investments. Dreams can change. One day, you might decide that you do not want that car anymore, you want to save for a house instead. Or you will find out you are going to have a baby, and suddenly, you have a new dream, to give your child the best life possible. Because dreams can change, it is crucial to regularly check if your investments still match up with what you want. It is like adjusting the sails on a boat. If the wind changes, you need to change your sails to keep moving in the right direction. Your life can also throw surprises at you. Sometimes, things go well, and other times, they do not. If you lose your job or face a big, unexpected expense, your investments might need adjusting to keep your dreams on track. In a nutshell, make sure your investments are like a puzzle piece that fits perfectly with your dreams. Short-term dreams need safe and stable investments, like a strong box. Long-term dreams can handle some ups and downs, like a roller coaster. And always keep an eye on your dreams and your investments, so they stay coordinated, no matter what life throws your way. Final thoughts. You have the key points of managing your money and making investments in a short and sweet summary. Just keep in mind, it takes time and self-control to set up a solid money base. Handling your budget, setting money aside, investing, and dealing with debt are abilities you'll use throughout your life that will really help you out. Keep on discovering and adjusting as you move forward on your money path. Armed with this knowledge, you are more ready to make smart choices and move towards a better money future. Thank you for watching Personal Finance Insights. We hope you found our videos informative and valuable in your financial journey. Do not forget to subscribe and hit the notification bell to stay updated on our latest videos. And as always, if you have any questions or comments, feel free to leave them in the comments section below. Thank you for being a part of our community, and we look forward to helping you make sense of your money.